What is going on? Welcome to my channel, fellow income investors. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income using covered call ETFs. Right now, my projected annual dividend / options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 per day, and roughly $9.42 per hour. Of course, I will be revealing my portfolio at the end of every month. Probably this month will be 26th, 27th. I would see. I'm not sure, but either one of those dates. But I will show you my holdings, current portfolio size, my buys or sales, or if I'm just holding cash. But stay tuned for that. Legal disclaimer before we start: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor or investment professional, tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on your YouTube algo. So I could be completely wrong. All right, let's get started. Today we're going to do some power ranking on one of your favorites. I've noticed a trend, and it seems like every video I make, especially on a deep dive, I've always hit or a video on like core holdings, satellite positions. I always see somebody, or not somebody, but like a few of you guys always talking about the 0 date time expirations ETFs. So and they're a big chunk of your portfolio. So I gotta make a video on this. I have to. You guys are obsessed with these funds, so let's actually talk about them. And I'm gonna be doing a power ranking based on my findings and what I think if I were to hold it and how it would perform. So you asked for it, so here's my honest breakdown. All right, don't flame me. All right, so let's talk about how Wall Street, of course, what you're buying, actually make money off this volatility, off this strategy, right? Let's look at the market structure, which has really fundamentally shifted, right? Especially the past 3, 4, 5, 6 years. We're seeing a lot more time compression, which is just trading in hours, not years, and economization, right? Which is just volatility, now a tradable asset class. The result is, of course, the explosion of this, right? The rise of daily income and 0 date time expiration cover call strategies, okay? What is the driver is, of course, the massive liquidity migration into short-dated options, right? The less time you have, the more money you can make, right? That's the strategy, is 0 date time expiration contracts, approximately 60% of the total S&P volume. So it's extremely liquid and extremely popular, has a lot of money going in and out. And so this is where the opportunity is, right? Issuers can now monetize intraday moves without killing returns via, of course, the transaction cost, right? The market moved from invest for years to trade for hours, and these ETFs are pretty much catching up, right? A lot of them are very, very spanking new. All right, let's look at that, how I'm ranking, right? This is my ranking methodology, right? I completely ignore the yield. Why? Because the yield is essentially a lie, right? Yield can be a very deceptive due to return of capital, right? So a 100% yield is useless if your principal drops 50%. So I'm ranking it by 1, structural robustness, right? Can it survive a crash? Total return, income plus capital preservation, and tax efficiency, right? Ordinary income versus capital gain. So these 3 I put into place, and I pretty much kind of rank the ETFs based on these 3. These 3 play a factor. All right, let's look at the spectrum here, right? So I'm gonna be moving from the speculative, which I would label the worst, to the structurally sound, which I labeled the best. Okay, we are analyzing operational mechanics and long-term viability, not just the payout date. Okay, this whole point of this YouTube journey, for those who are new, is reliable, consistent, and long-term holds, right? Can we actually do all 3? All right, so this is the goal here, is to stop you from buying a fund that pretty much will liquidate your principal while just paying you a dividend, okay? Quote unquote, that dividend. All right, let's look at the capacity modeling. When does it break? Of course, at what point do these strategies become their own worst enemy, right? We have to look at math. Math doesn't lie. Looking at SPX level at 6K, notional contracts, right? 600,000. So approximately contracts per 1 billion, 1,666. This is what we call the saturation point. It's just a FYI, right? Daily SPX 0-day time expiration volume is about 1.5 million, right? So out of the money strike clusters are thin, anywhere from 20 to 50,000, give or take, right? Looking at a 5 billion asset under management threshold, so a fund like XDTE would need to sell 8,330 contracts daily, right? That's 15 to 20% of a typical open interest at the open. The argument you can say that is anything above 5 billion, you essentially become the price maker, right? Your massive sell orders crush your own volatility premium. So at this point, you're the whale, and you kind of it goes against you when you do become too big. All right, let's look at systematic risk, right? This is row congestion and frugality, right? This is the morning bottleneck. So right as the market opens, the first hour and a half, right, you have a synchronization risk, right? So Roundhill XDTE, YieldMax SDTY, and Defiance WTTE all execute rows within the first 30 to 60 minutes, right? They are selling the same delta profiles, 0.30 to 0.60 out of the money at the same time. What this could lead to is the liquidity crisis scenario. The fragility part, right? In a massive gap down, everyone competes for the limited liquidity to close positions, right? This will and can lead to severe execution slippage that never shows up in backtests. So when everybody pretty much rush for the exit at 9:35 a.m., the door isn't big enough, right? These are big names doing at least thousands, if not in the millions, of options every single day, minute by minute, hour by hour. All right, let's look at daily versus monthly. This is just a benchmark battle, right? We're comparing, of course, my tier 1 zero-day time expiration structures against the best-in-class monthly strategies, right? Using JEPI or SPY. Just looking at this, obviously, the verdict here is daily resets fix the capped out all month problem, right? But introduce death by 1,000 cuts and downtrends, because you're doing intraday options. So as the market does trend downwards, you're getting cut. It's the falling knife here, right? You're getting cut every single time the market ticks down. All right, let's look at the worst. In my opinion, tier 4 is Total Capital. Why is this tier 4? Because I think right now is very speculative. If you're buying funds like MSTK, right, which is the MSTR, or BitK, which is Bitcoin, the flaw here is that Bitcoin and MSTR don't just have high enough of a volatility. They have explosive volatility, but IV can double overnight, right? Shorting calls and a volume volatility up, spot up regime is mathematical suicide, because you get capped at 2% while the asset rips 20%. Is the downfall. A lot of names that I mentioned does happen like this, and this leads to NAV erosion, right? Well, what's the volatility failure? So this is basically, in a normal market, high IV equals high return, right? In crypto markets, high IV often gives you a massive breakout, but by selling the call, you are shorting the breakout, right? You take all the downside of the crash, but miss the entire upside of the recovery, right? So this is a broken structure for long-term hold. This is pretty much for people who know how to, you get in and out, right? If you're an experienced, gambler playing a casino, you don't stay and just play. You got to know when you have a hot hand, go all in, and then cash out. You don't just, unless, obviously, counting cards is different, but I'm saying, you get in, you get out, you know when to take your wins, right? So this isn't just investing. This is pretty much gambling on means reversion. 50% yield with 50% erosion is zero return, right? The next tier 4, I'm going to say, is YieldMax 0-day time expiration series. Why is this a tier 4? Because of the erosion risk, right? Looking at SDTY and QDTY, right, the flaw I think they have is they prioritize that headline yield of 30% plus over total return, okay? High distributions often come from return of capital. They shrink the NAV. Right? A shrink in NAV means you have less capital working for you next month. This is the melting ice cube, okay? And on top of that, the synthetic drag, right? So these funds, I don't think they hold actual stock. They use a synthetic long, right? Which is buy, call, sell, put, plus short 0-day time expiration. So rolling deep in the money calls and selling 0-day time expiration daily involves massive bid-ask spread costs, right? This is a friction and acts as a permanent drag on performance compared to actually physically holding the index. The trap here is that high yield will attract the capital that kills the yield. It's a self-defeating cycle at scale, and people who fall for this typically look at the yield only, but not with the actual structure. All right, the tier 3s, right? These are the middle. These are the Defiance ETFs. Why is it tier 3? Because it's extremely complex. All right, so funds like WTE, QQY, they pivot from put right to credit spreads. While I think this is a good improvement, right? Spreads, sell A and buy B. It does limit your max loss if the market rips higher, but you participate in a tail rally, right? This is structurally safer than naked calls, but why would I not put this at tier 2, tier 1? Because of execution costs, right? This is the friction part. Managing a 3-leg trade, which is a short plus long hedge, daily will doubles or triple transaction costs. Okay, that's what not a lot of people are seeing behind this. And liquidity risk, they do rely a lot on the flex options, which is a custom contracts, which you don't have to worry about. These are for the big boys. These are for the people that have the 20, 30, 50 million, $100 million to play with, typically for hedge funds. But in a panic market, market makers widen the spreads on flex options first, so your theoretical exit price may not even exist in reality. So you might not even be able to go and pretty much end the contract and get your premiums, right? It could happen. It can happen. Okay, smart structure spreads, but the engine is too expensive. Your trading costs, Tier 3 is the middle ground of, again, Rex. Why is this tier 3? This is where you have to really look at the manager risk, right? So funds like ULTI from YieldMax, the strategy is that this is an active tactical volatility harvesting. It is not a systematic index fund. So they actively trade volatile names like NVDA and MSTR. And then, of course, the human element, right? This is the manager risk, right? You aren't betting on math. You are betting on a portfolio manager's ability to guess the direction of NVIDIA every week, okay? And of course, this can lead to a style drift. Because it's active, they can pivot strategies overnight. You cannot reliably hedge this position because you don't know exactly what they hold today and what they will do tomorrow, right? So the objective here is you got to ask yourself, can a human manager consistently beat the variance risk premium? Historically, the answer is no. Just looking at data, and it proves a lot. All right, tier 2. This is where you can kind of get your foot wet. Maybe, perhaps, if you know what you're doing, make it a core, right? So we're going to talk about ProShares high income. So why is this tier 2? Well, this is where I want to say this is the institutional scale here. Funds like iSpy and IQQQ, right? The pros is that they use swaps with major banks, right? So this at least guarantees perfect tracking of the index with zero execution slippage, low fees of 0.55. But why is it not tier 1? Because I think taxes is the big problem here. I think right now it's ordinary income. Correct me if I'm wrong, but I think it is ordinary income right now. Swap income is generally taxed at ordinary income. I could be wrong. So I'm going to say right now, you do not get the 60/40 tax advantage of Section 1256, right, that you can get with direct index options. So for a high earner, right, this tax drag destroys the net return compared to a tier 1, okay? Still a great product, but terrible taxes. If you're into this type of stuff and want to work for a while and have an IRA, best for IRA, but maybe it's not as great for a taxable account, especially if you're a really high earner. All right, this is the tier 1, right? This is the Roundhill investments. Why is this tier 1? It has the tax alpha, right? So the ones like XDTE, QDTE, RDTE, right? The advantage here is that they trade direct index options of SPX and NDX. So this qualifies for Section 1256 tax treatment, giving you the 60% long-term and 40% short-term rates, right? So give you a blended rate of 27%, right? So this creates a massive after-tax structure advantage over ProShares and other tiers, right? And of course, they have the uncapped overnight. The mechanic is they sell the option at the open at 9:30, right? And then they are uncapped overnight, right? So historically, a huge chunk of market returns comes from the gap up at the open. Roundhill captured this, right? And ProShares with the 1-day time expiration usually misses it, right? So tier ones, of course, are the tax king, right? If you're in a taxable account, this is a structural winner. And of course, the best, right? Tap Alpha for those who own it. Good job, right? Why is this tier one? At least I think they have the best physical integrity, right? So the funds here are T-SPY and TDAC. The structure, they hold actual SPY and QQ shares, right? So no synthetic financing costs here, no swap counterparty risk, right? And the growth focus, they target lower delta, which is further out of the money. So they do aim for a 50% yield, not a 50% yield. Very, very doable. I would say as long as they know what they're doing, very sustainable and reliable and consistent. It is also the total return winner. It has given the upside participation. So by selling further out of the money, they capture roughly 80% of the upside versus about 50% for the peers that I've mentioned, right? So this allows the NAV to actually grow over time, right? So this has the scalability, which is the physical replication is infinitely scalable, right? They don't distort the options market as fast as synthetic funds. So scalability also can mean NAV growth and long-term, which can mean long-term hold, right? Physical is always going to be synthetic, in my opinion. Growth always beats yield chasing. The most robust structure for long-term hold is T-Alpha right now, TappAlpha. All right, let's look at the strategic stress test. Of course, this is my matrix, right? So in reality, if you put it all together, you look at it, there is no all-weather fund. In a trend, you need TappAlpha. In a chop, you need YieldMax, right? We don't hate on any of this. That's not what this channel is all about. That's not what I'm all about. I talk about the good, the bad, the ugly, the beautiful of it all, right? So if you look at it, you see the different winners and you see why, right? So each one does its own thing. Each one does have its own Goldilocks, the regime, right? So, the Goldilocks is slow grind for Roundhill and TappAlpha. YieldMax does best choppy, right? TappAlpha and SPY does best in a trend, obviously, right? So, and none of them would perform great in a crash, obviously. All right, let's look at the compounding drag and tragedy of the commons. What do I mean by this, right? So just looking at a geometric drag of the setup of a 10-year horizon, right? 8% CAGR underlying and a 0.5% daily cap. The result is that most of these zero-day time expiration strategy will lag index fund by 20 to 30%. Okay, the key takeaway is that it is a cash flow smoothing, not wealth maximization. Please understand that part. This is why, if you're trying to build around this as a core, I would say know what you're using, to build around it that has growth, because zero-day time expiration is probably the best, in my opinion, for cash flow. But in terms of building wealth, this is where even a short actual bear market will absolutely destroy you, right? So let's look at IV compression loop. What it is if capital flows in, right? Let's talk about, for example, 25 billion plus, selling pressure crushes zero-day time expiration IV, right? This is the feedback loop. So the yield falls, sell close to the money, capping increase, NAV erodes. So this is pretty much just going into a circle. You see that it can get very, very dangerous here, right? Success is the biggest risk. Too much money kills the premium. So in a day, as much money as we want, we gotta be like, okay, look at the fund and look how they're executing their plays. All right, regulatory risk. Of course, regulatory risk happens to not just these type of funds, happens to anything that we hold. So the scrutiny can happen to all of us. They can change the law and they can put pressure on Congress, Section 1256 reforms, right? A lot of these things can change. So understand that the tax advantage that we have is pretty much a legislative gift, right? So any reform targeting these could essentially wipe out a lot of after-tax gains, right? So one rule from Washington could destroy the Roundhill, YieldMax tax strategy, Niels, Goldman, Amplified, JP Morgan. Hopefully it doesn't, of course. All right, this is just a summary. I put it all together. You can pause the video, but essentially, I repeat myself here. Physical beats synthetic. Structure matters more than yield. All right, so you want to make this a core, right? This is for you if you are the cash flow first lifestyle. All right? That means you don't care about beating the S&P 500 in 20 years, right? You care about paying your mortgage, your rent, paying your bills today. You need 15% cash flow to live without selling shares. Well, Tier 1 funds does, right? T-SPY, XDTE becomes your paycheck. However, you do accept a lower total growth for liquidity now. Okay, the lost decade hedge, right? You think the market is going nowhere. So in a flat market, S&P returns essentially zero. These funds return 50%, right? If you are bearish on growth or expect 10 years of stagflation, this is the superior core holding. You win when the bull loses. Understand that. You do not win if bull wins. This is where you're like, okay, you're going to just completely get blown out. This is where you have to build this around growth first, income second type of ETFs, right? It's not for max growth. It's for max lifestyle. If you prioritize cash over compounding, this is your core. If you agree with me on that, let me know. If you don't, let me know why. I think this is very true here. I think I don't know if you want to dispute that, but I don't think this is for max growth. You can let me know. I think 0 daytime expiration or for the extreme of max lifestyle. All right, but if you're not that, then you're this. Do not buy if you're this type of investor. You are the gamma blind investor, right? You think it's just SPY with a dividend. Stop. All right, hold off. Nope. You'll get run over by intraday volatility and convexity risk. I do not buy if you're the growth maximizers. I say this again, right? If you want maximum compounding over 10 years, daily cap acts as a geometric drag, okay? You will structurally lag the index in a bull run. It is simple math. Do not buy this if you're a pure yield chaser, right? If you pick the ticker with the highest percentage yield, you're essentially buying a melting ice cube. You will face NAV erosion in reverse splits. As has happened, I've made videos on this. Do not buy if you're the panic seller. Why? Because of distribution, right? It varies very wildly. So if a 30% cut in the monthly payout makes you panic sell, you don't have the stomach for this asset class. It's not for you. Just stick with the index here, right? Ruin chill for you. All right, that's my warning here. Yield without structural awareness always leads to the slow motion liquidation of your principal. All right, this is my power ranking verdict before I end it. Why does TAP win? Again, not everyone will may be a fan of this or even holds it, but at least for me, my research proven that TappAlpha is the winner here because they balance the derivative, which is your income, with asset, right, and which is your growth, right? YieldMax failed because they sold the asset to pay you the derivative, okay? The bottom line is the power ranking is not just the list here. It's pretty much my survival guide when I'm putting these together. Which one do I make this a core? Which one do I eat? Even tier ones, I would make it a core satellite, right? So if you treat tier 4 funds like a bond substitute, you will lose. It's basic math. You will lose. If you treat tier 1 like a tactical tool, you win. You understand how they execute their strategy. Respect the ranking and save your portfolio. All right, thanks for watching, guys. I appreciate all of you guys. I hope this was informative. I hope you got something out of it. If you did, subscribe, comment, like, show some love. I'm always open to new ideas for the next video. I've just been seeing a lot of comments mentioning 0 daytime expiration, and a lot of you guys are pretty much making this a core holding. Let me know if you guys have a lot of money in one of these picks. Let me know how much you have. I'm interested to know if you guys have like 50, 100, 150, 200, 300, $350,000 in this. Let me know. I'm interested. If this is your core, I need to know. Thanks for watching. Stay tuned. Catch you guys on the next.